Oh boy, we are headed up on Disney's quarterly disaster, or at least a potential disaster. You see, the second week of August is set to be quite an eventful one for many investors, as several major companies are scheduled to release their quarterly results. And of course, among the headliners, you guessed it, Disney's Q3 earnings report is going to be the most anticipated. It's going to be yet another Dismal Disney update here, and while shareholders are keen on the company's financial performance, I am more interested in the inevitable fallout from Wednesday's quarterly meeting. That's right, we're looking at a meeting on the 9th that I think is going to be, well, very disappointing for everybody involved. It's going to be a lot. So let's look into the future, shall we? Here we go. So when looking forward, it's always a good idea to look backward as well. You see, trends can say an awful lot, but in this case, what's telling is the financial press and, of course, the stock performance itself. Of course, I have to give the standard disclaimer here that I am not a financial professional in any capacity, and I'm certainly not giving you any financial advice. I rely on professionals myself and a whole lot of research when putting these videos together, but you should take this with an appropriate amount of salt and talk to a professional of your own. So, in pursuit of this prognostication, I started out with Seeking Alpha, and this time, I have to say I was well rewarded. Seeking Alpha's quant rating system presents a cautious outlook for Disney. They're rating the stock as a hold with that tool due to the valuation concerns, and I seem to agree with that. However, sell-side analysts are a little more optimistic, which I don't understand. They're giving Disney a consensus buy, and it doesn't make any sense to me. There's a growing stack of negatives out there, but hey, you don't get paid for it, so blame your professional. Now we go looking into who does similar stuff, because that's another way that you gauge performance of, well, any company. And in terms of competition, Netflix reported mixed Q2 results. Roku exceeded expectations, and Warner Brothers Discovery, as we know from last week, fell short, but just barely, and for a lot of different and interesting reasons. Seeking Alpha contributor Pink Sands Value Investor says cost-cutting and dissipating negative sentiment provide tailwinds for stock appreciation. What? That didn't even make sense. Grant, how are you feeling about Disney right now? Yeah, that's what I thought. Look, I'm not sure where they are getting the dissipating negative sentiment from. Disney is getting hammered on all sides. Forbes and Fortune magazine and many others have been teeing up Disney as, well, a failing company for several weeks now, and I would call that an increasing negative sentiment. Wouldn't you? Of course, regardless, we're going to look at some actual numbers, which are always rather telling. See, the consensus estimates for Disney's Q3 earnings are placing the EPS at 99 cents, and revenue estimates put it about $22.54 billion. And earnings insights are, well, Disney's streaming giant element, Disney Plus, is a track record of beating EPS expectations in 4 out of the past 8 quarters and exceeding revenue estimates in 5 of those reports. What does that tell us? Well, it says very little and nothing positive, because a 50-50 track record isn't actually good here. But there are some factors that are being completely left out of Seeking Alpha's analysis by their experts and even their quant analysis. ESPN is struggling, and this is straight from the New York Times. From financial engine to growth challenge. That's how they're describing ESPN. This article correctly identifies ESPN as a long-standing financial engine for Disney. Of course, it's always been that way. Well, for the most part, since their acquisition. But ESPN and the parks, they used to rely on, well, their earnings. They were basically a license to print money and spend all manner of ridiculous money on a bunch of wasting endeavors. And they've done a lot of that recently. Yet, despite continuing to generate billions of dollars in revenue for Disney's cable networks division, Wall Street's focus on growth and profitability has impacted the company's perceived and actual performance. In the first 6 months of the 2023 fiscal year, revenue has declined by 6%, while profit dropped by 29%. Yes, Disney, you lost 30% of the interest you had in sports products and what you produce with them. If it weren't for the price raises and inflation, revenue would have declined far more than that 6%. To address the issues, Disney is exploring the possibility of selling a stake in ESPN to strategic partners, a story which we covered here last week. And they're looking for somebody to help assist or distribute or even create content. And as I said, I actually covered that here on the channel in the last 2 weeks. You can see that video right there. So to that end, the company is engaging in talks with a lot of partners, including the NFL, the NBA, and Major League Baseball about potential minority stakes. And as I've mentioned previously in videos and on shows, I expect those organizations politely took that call and then laughed for hours after they hung up. That would absolutely crush their bottom line, and they already have their own networks for that kind of direct-to-consumer access. So it would be, well, an expensive waste, probably is the best way to describe it. To navigate the challenge of ESPN, Disney has enlisted the expertise of former senior executives Kevin Mayer and Thomas Skaggs, who, of course, I reported last week. They're there to consult on ESPN strategy and explore some potential deals. Sure they are. There seems to be a growing level of uncertainty regarding the specific type of strategic partner ESPN seeks and the areas in which it needs assistance. There is also a fair amount of speculation that Skaggs and Mayer's move has entirely different motives, and I seem to fall into that category. Now, the key problem is ESPN's main revenue stream comes from affiliate fees, which have been destroyed by accelerated cord cutting, which we've talked about here on this channel for years now. And while ESPN has raised its affiliate fee to offset the decline in the cable subscribers, it will face more limitations going forward in upcoming years because as a number of cable subscribers is expected to decrease significantly, well, so will obviously ESPN's and pretty much everything else in cable. I mean, we're talking about a rapid decline here. And at the same time, the costs for securing the sports broadcast rights have surged exponentially even. Every league is looking for huge paydays well above the last contract, which was also a massive deal. So this is further straining ESPN's financial resources to the point that, well, exclusive rights could be in jeopardy. ESPN Plus is the streaming service that has garnered over 25 million subscribers, but it's primarily attractive to diehard sports fans due to its limited content selection. And if you've ever looked at it, there's very little on there. So the question is, when will ESPN offer itself as a standalone streaming channel, separate from a bunch of bundled packages? That is a question that remains unanswered. So whatever the pricing challenges and the potential impact on the cable bundle model, you're going to have even more significant obstacles beyond those. Here's a question. Would someone be willing to pay $35 to $42 a month just for ESPN? Hey Grant, does that sound good to you? Me either. Let me tell you, there's a major problem here. Major. According to some recent trends and some streaming surveys, people, up to about 44%, in fact, are looking to leave services now. They're pushing churn rates up at every major player, including Disney. Disney Plus, the churn there is up. You got Hulu, the churn there is up. I mean, I can go on and on. Warner Bros. Discovery, etc., etc. And despite it all now, right now, ESPN's vast rights to live air games and its popular website are among its key strengths. And as the company tries to evaluate a strategy to fix everything else, the future of ESPN will depend on its ability to find the right balance between a dying traditional cable model that, well, isn't going anywhere anytime soon, and an overpriced digital offering in, well, whatever form that takes. Next, we have to look at the biggest elephant in the room, right? Disney's decimating decline in the box office. Highlighted, of course, by the biggest failure of this year thus far, Lucasfilm's Indiana Jones 5. But as you know, it wasn't alone, at least not for Disney. Disney recently was known for its blockbuster successes in franchises like Marvel and Star Wars, but they've encountered a difficult summer box office this year with nearly $1 billion in losses. And I would say it's probably much higher than that. The much anticipated return of Harrison Ford as Indiana Jones in The Dial of Destiny has put it, well, to put it rather kindly, underperformed, failing to break even despite its substantial budget. But of course, I would say it's because of its substantial budget it had no chance of finishing at break even. But anyway, I digress. The film is destined to go down in history as one of Hollywood's biggest box office bombs. The hubris, agenda, and character destruction of Indy certainly did not help matters much, with many fans using the performance of the film as an exclamation point at the end of Kathleen Kennedy's destructive leadership, and of the studio as a whole. Most recently, Haunted Mansion, a reboot of Eddie Murphy's original disappointing attraction film, arrived with an equally disappointing attempt itself, with meager opening weekend earnings just a couple weekends ago now. And at the time of this recording, I guess it's sitting at about $59 million over 10 days. So this film is indeed DOA. Well, I guess ghosts DOA. Anyway. Next in line was the big budget The Little Mermaid live action remake. And again, it points out or illustrates the fact that these are now a really bad idea. To say this struggled to meet expectations would be an understatement, and with a reported production budget of over $250 million, again, that's likely well under what it actually cost to make the film, and at least $100 million marketing effort, well, to date, Little Mermaid 2023 is still at least $100 million in the red. Even Pixar's Elemental, while showing some late and suspicious recovery in the last few weeks, it had one of the worst openings in the animation studio's history, with just $29 million domestic. To date, globally, this film still sits at an unprofitable $423 million after dragging it out in theaters for a bunch of weeks. This adds even more red ink into the balance sheet at a time when Disney can ill afford it. So, unsurprisingly, Disney's only real summer success has been Guardians of the Galaxy Volume 3, which has earned $844.9 million worldwide. Overall, Screen Rant, drafting of course on Valiant Renegade's work of course, estimated that Disney could incur losses of nearly $1 billion, making this the toughest year for the studio yet. No kidding. How about well over $1 billion? I still think it's well over $1 billion. As Disney faces up to the fact that consumers don't trust them much anymore, shareholders no doubt eagerly await the company's quarterly earnings report midweek. Again, on the 9th. I'll be watching. They are hoping for signs of recovery and strategic initiatives to address economic headwinds and the decline in consumer sentiment towards the company as a whole. Good luck. I, for one, think that they will be rather disappointed. But more importantly, what do you think? See, we've reached the point in the video where it's time to leave your comments down below. So let me know what you want to talk about regarding this, and I think we'll have quite the spirited discussion indeed. And before you click away, please do me a favor and like the video down below. And double check that you're still subscribed. You see, there's a huge percentage of folks that still aren't. Or they've been accidentally unsubscribed, so make sure that that button's not red still, and turn it to gray. Of course, have a wonderful day, and until next time, see ya!